It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, we're combing through the balancing act that is debt in the retail landscape. I'm here with Chad Morganlander, Washington Crossing Advisors, Senior Portfolio Manager. Great to see you, Chad. Thanks for coming in.
Thanks for having me, Julie.
And first, we have up a stock for the gentleman farmer, for the cottage core among us, Tractor Supply.
Right.
The stock's up like 27, 28% over the past year, so it's done pretty well. But let's go through why you still like it here. The dividends are rising and the company's growing.
Yes, this company has had a long history of having a wonderful balance sheet, steady Eddy cash flow stream. So it's growing, it's profitable, very little debt, and it's a rising dividend company.
Are you a Tractor Supply customer? I'm curious.
No, but I've been in a bunch of them before.
Gotcha. I didn't know if you're a gardener. I don't know. High return on capital business model. Talk to me about that, because the company has been putting a lot of capital into its stores.
Absolutely. They have over 2,400 stores. Just keep in mind that their footprint is in rural America, right. So it's a low type of rental or ownership type of business model. And there's not a lot of capital investment that they need to put forth to get a higher return on that invested capital. It's a very steady, sturdy business model, and they've been able to grow in a very efficient manner.
And we've seen also the growth as people have been moving to some extent, right? Moving to more rural, especially during the pandemic, right?
Absolutely.
So it is people who farm for a living, but it's also people who farm or do yard work or whatever for fun.
Right. So during COVID, they got that shot in the arm as people moved away from the city life to more urban life. You would have thought that perhaps that would have scaled back, but in fact it didn't. They have roughly about 50% of their revenues come from feeding not only farm animals, but pet food. So it's a steady Eddy, more predictable revenue stream, and we believe over the long run that will continue. They're not as economically sensitive as the next one.
Gotcha. All right, but let's talk about a potential risk, as we like to do here on Goodbye or Goodbye, and that is if we do see that shift. Like, what if all those people who moved out move back to cities?
Oh, absolutely. And we believe that will happen to a certain extent. We have modeled that out. But we think that over the course of the next 3 to 5 years, the growth rate's going to be between 3 and 6% on the top line. We're not expecting, nor do we need to make this company and this stock attractive, a robust growth rate on a go-forward basis.
Gotcha. And you do own shares of Tractor Supply?
Yes, our family does own shares.
Okay, let's get to the stock that you do not like. This one also in retail, and it's Macys. Now, this stock is also up over the past year, about 19% or so. There's been a lot going on in terms of activism, et cetera, but you say they still have too much debt.
So Washington Crossing Advisors shies away from companies that have a lot of leverage on their balance sheet. They've got roughly about $2.7 billion of debt and then $2.5 billion or so of actual leases. That is a problem. We think that's more of an anchor, which is a real issue over the long run in a very competitive retail environment.
And that's at the same time that the company is not growing in terms of revenue. Let's take a look at the revenue chart here, because what you see here are these various things are kind of holiday seasons, right? But they're descending, and then the non-holiday times are also so in other words, they're just not growing as much.
They're trying to rationalize their footprint, and it's like a battleship trying to make a U-turn in a closet. It's very difficult in doing that. It's going to contract their top line, but the issue really has to do with such a competitive environment. They really have to find their way, and that's part of the problem. They have online retailers that are price competitive, and then they have the higher end retailers. It's a tough business.
So being in the middle is a tough place to be right now.
The middle ground is a tough place.
Yeah, and so they're exposed to those sort of consumption trends. We just saw retail sales this week, for example, that were not fantastic.
Yes, and in your previous episode that you just did, they were talking about slowing of the consumer. As consumption patterns decelerate, as COVID relief spend down continues, it's going to affect the lower income as well as the middle income consumer. Macys may be more exposed to that than one would like. Hence the reason why if you have a lot of debt and you have a contracting top line, any type of economic impulse on the downside could have deleterious effects on this type of thing.
So what could have good effects? As always, we look at the other side of this.
Oh,
maybe they delever the balance sheet. What would that even look like?
Well, they would have to delever it quite a bit. They do have some very interesting properties that a private equity firm may be more attracted to. They may have to take a company like this private, clean it up over a decade to then bring it back out there into the market. But this is a very tough business to be in. And when you have a lot of leverage, a lot of debt, and you don't have pricing that's very sensitive to outside competition, then you're really setting yourself up for a tough go.
Gotcha. Okay. And you do not have a position
No, we do
in
not.
Macy's. So again, you're recommending folks take a look at Tractor Supply, avoid Macy's in this environment. Thanks, Chad. Appreciate
Jill.
it. Have a great weekend.
You as well.
And thank you for watching Goodbye or Goodbye. We'll be bringing you new episodes next week at 3:30 p.m. Eastern.